Most investors are keeping their fingers crossed, praying that the Fed is an expert pilot, skillfully guiding our economy into a soft landing. But what if I told you that DoubleLine Capital, the financial wizards they are, see a different path, a rather bumpier one? While many investors are sipping on the soothing narrative of an expertly managed economic slowdown orchestrated by the Fed, Jeffrey Sherman of DoubleLine Capital splashes cold water on this comforting scene. In a recent Bloomberg interview, DoubleLine's Deputy Chief Investment Officer said he foresees a not-so-distant future where the Fed's efforts might lead us straight into a deep recession. So, here's a tricky question for you. Do you trust the Fed's ability to land this plane smoothly? Or do you share Sherman's concern that we could be heading toward an economic turbulence? Let me know in the comments section below. But before we dive into this turbulence, we'd like to welcome you back to Investing Lighthouse, where we're all about making investing less intimidating and more rewarding, one video at a time. First, a quick rundown about DoubleLine Capital, the source of our discussion today. Jeffrey Gundlach founded DoubleLine, a major asset management firm that oversees an impressive $92 billion. Known primarily for its expertise in investing in fixed income securities like bonds, the employee-owned investment firm also invests in equities and commodities. At the core of Sherman's forecast are rising interest rates. The Federal Reserve has been raising rates to curb high inflation, a necessary but risky maneuver. While it's a proven method to combat inflation, higher interest rates can also slow economic growth. It's a delicate balance, a dance of precision. Tighten too little, inflation runs wild. Tighten too much, you risk choking the economy. Sherman's concern lies in the Fed's timing. He claims that many economic indicators are either warning or signaling a recession. As signs of inflation cooling off start to emerge, he fears the Fed will be slow on the uptake, maintaining high interest rates for too long and inadvertently pushing the economy off the cliff into a deep recession. Sherman suggests that by the time the Fed responds by cutting interest rates, it would need to be a dramatic 1 percentage point cut, the biggest since the pandemic struck. Sherman is not pulling these conclusions out of a hat. In his opinion, evidence of this comes from the bond market. Sherman points out an anomaly called yield curve inversion, where short-term interest rates exceed long-term ones. Historically, such inversions have often been the canary in the coal mine, signaling an impending recession. To prepare for this predicted downturn, Sherman suggests a strategy that includes buying long-maturity government bonds, specifically 10-year and 30-year treasuries. He believes these bonds will provide a safety net, irrespective of whether the Fed decides to hike rates further, as he believes that long-term yields have peaked. On the other hand, it is interesting to note that he also advocates investing in shorter-dated investment-grade corporate bonds that continue to yield decent returns and are not immediately at risk of default. As Sherman explained, most quality companies have already extended the terms of their debt. Sherman predicts that this time, the default cycle will likely be led by the loan market rather than high-yield corporate bonds. Let's unpack this. Typically, most loans these days are floating rate loans. Think of your line of credit as an example. They're not fixed, meaning the interest rate on these loans varies with the market interest rates. Now, with the Fed on a rate hiking spree to tackle inflation, these floating rate loans feel the full brunt of these rising rates. And with each hike, the interest burden on these loans gets heavier. Think of it this way. Let's say you've taken out a floating rate loan of $10,000 at an interest rate of 5%. You're paying $500 in interest. But if the rate hikes up to 6%, suddenly you're shelling out $600. And if the rates continue to rise and reach 7%, you're now paying $700. That's an additional $200 from when you started, which can impose significant financial strain on both individuals and businesses. On the other hand, fixed-rate loans, which have a set interest rate for the duration of the loan, have a buffer period before the rates reset. They do not feel the immediate impact of the Fed's interest rate increases. This discrepancy between the two types of loans is why Sherman points towards the loan market as the potential leading force for the default cycle this time around. Although Sherman doesn't see any immediate danger of a recession this year, he projects the cumulative effects of the rate hikes to spark off the forthcoming default cycle, likely to commence within the next 12 to 18 months. In light of Sherman's analysis, it's important to remember that markets are cyclical and change is the only constant. However, change also means opportunity. Even in an economic downturn, there are investment strategies to hedge against losses and potentially find growth. Regardless of market conditions, we're here to help you understand these strategies. Because remember, in investing, knowledge isn't just power, it's profit. That's why we're here at Investing Lighthouse, to illuminate the way forward, guiding you to make informed decisions in your journey toward financial freedom. But that doesn't mean we can breathe easily. The New York Fed's U.S. recession gauge just hit a 40-year high in June. Moody's predicts the default rate of speculative-grade companies worldwide could climb from 3.8% to 5.1% next year, and under the worst circumstances, skyrocket to a terrifying 13.7%, exceeding the 2008-2009 credit crash level. The takeaway here is not to panic, but to remain vigilant and be prepared. Keep an eye on the loan market and be aware of the possible risks associated with floating rate loans. We're optimists here, but optimism should never cloud pragmatism. While we hope for the best, preparing for the worst is crucial. It's all part of being an informed and prepared investor, ready to navigate through the ups and downs of the financial market. Remember that investing is much more like a marathon than a sprint. As always, we're here to guide you through these roller coaster rides of the financial world. So buckle up, hold tight, and let's ride this roller coaster together. If you found this video helpful, please make sure to hit the like button and share it with your friends. Don't forget to ring that notification bell too, so you never miss an update from us. Remember, your subscription to our channel fuels our mission to demystify the complex world of finance and investment. So, keep the support coming. Until next time, happy investing!